The next learning objective is to compute the standard financial ratios. No single ratio tells the whole picture of any company's performance. Different ratios explain different aspects of a company. The ratios we discuss in this chapter may be classified as follows: measuring ability to pay current liabilities, measuring ability to sell inventory and collect receivables, measuring ability to pay long-term debt, measuring profitability, and then finally analyzing stock as an investment. So the first group we're going to look at is the ability to pay current liabilities. Working capital measures the ability to meet short-term obligations with current assets. Two decision tools based on working capital data are the current ratio and the acid test ratio. The most widely used ratio is the current ratio, which is current assets divided by current liabilities. Now we're going to get into these in more detail. This is just an overview for now. The current ratio measures the ability to pay current liabilities with current assets. The acid test, or quick ratio, tells us whether the entity could pay all of its current liabilities if they came due immediately. That is, could the company pass this acid test? So let's look at these in more detail, first starting with working capital. So working capital measures the ability to meet short-term obligations. The formula is you're going to subtract current liabilities from current assets. This will result in a dollar amount, such as $50,000. So it's not going to provide you with a ratio. Next, we're going to look at the current ratio. Now, in previous chapters, we've had many of these ratios, so some of this will be a review. So the current ratio is a proportion of current assets to current liabilities. So this one is not going to give us a dollar amount. It will give us a ratio. So the formula is current assets divided by current liabilities. And as I said, it's going to give you a ratio like 2 to 1. It's not going to give you a dollar amount. So if there's a ratio of 2 to 1, that means you have $2 of the item on top, current assets, for every dollar of the item on the bottom. So that would mean you have $2 of current assets to pay $1 current liabilities. A result of 1 would mean the company has the exact amount of current assets to pay current liabilities. So which is preferred, a high number or a low number for this ratio? Well, preferably you'd like to have $1 billion of current assets and $1 of current liabilities. That's the extreme, obviously, so by making it extreme numbers, it's easier to figure out. So we want a high number. But you don't want it too high. If it's too high, it could mean the company is too liquid and not using its assets effectively. Some companies generate a lot of cash and then just let it sit there and accumulate. So the current assets would get larger and larger and larger. So you don't want a lot of current assets just sitting there without being used. So again, within reason, you'd rather have this be high, but not too high.